Hey everybody, it's Pete Carmesino here at Chaikin Analytics. Thanks for joining me on the halftime show here at StockCharts TV. Each and every week, kind of go over a lot of things that are happening in the market. We look at some different charts and different angles and different ways to view things. Certainly looking at the ACP platform and then jumping over to the Chaikin system. So I appreciate you joining in and tuning in every week, and certainly leave me some feedback as well. So what do we have here? We've got a mixed market right now. Looks like as I record, the Dow's down a little bit. You got the S&P rallying and the Nasdaq rallying. So you're seeing this teeter-totter, again, this seesaw market. For some of you who have been following me for many years, you know I started using that term back in 2021 and 2022. And there was a lot going on. There was always this push and pull back and forth. We're seeing that right now. You see the Dow rally one day, you'll see the S&P fall, and then vice versa. Now, that's sort of a component of what's happening in the underlying indexes, right? And I think tech's taking a break, and I think it's giving value a chance to sort of catch up. Now, we're going to look at a couple of channels that I built on the Nasdaq and on the S&P. I just think it illustrates, what you could see, what you could expect. Now, if things change, obviously the illustration is going to change as well. So you have to kind of keep these things sort of on your radar. And I think if you can build or duplicate the chart that I built, I think it'll be useful to you. So take a look at it and see what you think. When I pull it up. The other thing we're going to go over is just look at the FANG index. I kind of like to keep a barometer on that as well. And I want to look at energy. The energy sector right now is looking very, very interesting. And I think it has to do with obviously the interest rate narrative, the dollar narrative. All of this stuff is connected. Really, nothing happens by itself, right? If something is changing over here, another sector, another industry is going to be affected on the other side. So you just have to kind of connect the dots, right? I always said I'm not the sharpest tool in the shed, but I play a mean game of connect the dots, and that's really what this market is about. I think you have to sort of connect the dots and see, okay, if this happens, and typically this happens, and it doesn't always work out, 1 for 1 or 2 for 1, whatever the number is, whatever the correlation is. But over time, the trends sort of push that way. It's almost like reading a green in golf, right? You can see the break, you see it happening, it's there, then believe it. It's going to probably break left if you see a giant hill on the right side of the hole. So just don't believe what you see. Sometimes it's not a myth, right? Sometimes it's actually happening right in front of our face. So let's dive into some of the charts here. There's one thing I want to start off with. I want to start off with this new narrative of the rate cuts that people are expecting either the end of this year or the beginning of next year. And I think I've got one very simple correlation that I think if you keep this on your radar, you could be sort of very in tune with what's going on out there in the Fed. Now, again, I don't know if it's going to work, but we're going to look at something from 1955 forward. That's just a quick correlation of two items, and I'll show you that right now. Okay, this is the first chart that I was alluding to there at the end of the first part of the video. And the two items are the unemployment rate and the Fed funds effective rate. Now, you can go to the St. Louis Fed and build a chart just like this, just like I did, just overlay these two on top of each other. Now, I'm going back from the 1950s, right? 1954, 1955. And obviously the red one is the Fed funds rate and the blue line is the unemployment rate. You can see it clearly right there, annotated on the chart. And as the Fed fund rates increase, you will start to see unemployment eventually, not immediately, right? Not immediately, eventually start to tick up, which then can and mostly does quantify or sort of validate a recession or creates a recession. Now, not all recessions are terrible, and we don't like the fact that some people might be unemployed. But the point is that this is what we have. This is the data we have going back several years, and we're not looking at 1 or 10 or 15 or 20 years. We're looking over 50 years of data, 60 years of data here that shows you that it typically happens this exact way all the time. Here you're seeing back in the 70s, the Fed funds rate had to rapidly rise. Unemployment jumped. What happened? The Fed cut rates, then they had to raise them again because inflation wasn't dying and things weren't happening. And then what did they do? They cut them again. So typically you start to see that. Here's the rise again in the late 80s. Unemployment, you can see, was low, stagnated a little bit, and then finally pushed higher. What did the Fed funds rate do? It fell. Same thing happened here. Again, as unemployment rose, the Fed funds dropped once again. And here we are again. It's the same setup over and over. Now, I don't know if it's going to happen again, but I like, for me, the simple version of what potentially could happen is probably the better one to use. So just keep this on your radar. I think this is an interesting chart. Believe me, I'm going to be looking at this week to week, maybe not on every video, but certainly in my own research, and I'll probably pull this up periodically during the course of our broadcast here on StockCharts TV. Hey, just a reminder, follow me on Twitter. It's at Pete Carmesino. I kind of put out some things ahead of time before the video, so you can start to look and kind of think about what I'm thinking about, or see what I'm thinking about anyway, ahead of the video. And that's this Nasdaq channel chart, which I'm going to look at right now on the ACP platform. All right, here we are on the Nasdaq, the NDX, $ NDX here on ACP platform. It's a daily chart. I'm using candlesticks just because I like to see sort of the low print. And I built the channel as best I could at the highs and lows of what's happened since really November and into the beginning of 2023. So that first pullback is really where the channel starts. And that was about 11, almost 12%. The second one was about 9. Now it went from the top of the channel right here. Again, these are just, this is just a parallel lines that are moved along and on the top and the bottom. I didn't create these. It's an automatic way to create it here on the annotation. You go here and you hit channel and you build one, right? So again, if we see this thing pulling back to this low again, it's about a 10% pullback roughly. It's been about 9 here, about 12 here or so. So anywhere between 9 and 12%. The only sort of curveball that the Nasdaq might throw at us is this 200-day. The spread between the 200-day and the price is pretty wide, and typically doesn't stay that wide that long. And obviously this slowdown is sort of, I would say, normal and orderly so far. And if it does go a little bit further, I kind of put the percentage change, anywhere, could be 18%. I doubt that, but I'm not saying it's not possible. But there's the 12% level, right around that 14,000, right? So if this sort of meanders here sideways and it gives the 200-day room to catch up, all right, the channel might be broken, but the 200-day might come in and catch it. And what you'll see on the S&P on the next chart kind of validates what's going on there as well. Okay, here's the same chart on the S&P. Again, going back from that September, October low here in the S&P, you saw the first pullback almost 11%. Another one at 8 didn't quite get to the channel. The next one did at a 9% pullback. And then here we are again at the top of this channel starting to pull back. If it happens, it could be 9.5%. It's worth noting that this was my support level for many months in a row here until we broke out just recently, obviously back in the May, June timeframe, several times to get through here. 1, 2, 3, 4th time's a charm, but it certainly had to come back and test it one more time, didn't it? But that 41.72 is lining up right with the low of the channel. So it's interesting. The other thing is, look at the 200-day, like a magnet to the bottom of the channel. Again, the 200-day is drawn based off of what the price action prior to today, and the channel's just being drawn off the lows. So very interesting the way the technicals set up a lot of the times on our charts. All right, since we're going to be talking about the S&P energy sector here, I thought I'd pull up the actual index. It's $ SPEN. And you can see I had some wedge or sort of trend lines here drawn from different levels back all the way from 2021. This is a daily chart. And so if I just zoom in just a little bit and kind of squeeze the chart to the left, let me make this larger so you can see it. You can see what's happening, right? We're certainly breaking out of this downtrend move. We're looking at potential crossover. And if you're looking at the energy versus the SPY, the ratio chart, it's certainly pushing higher. There's no doubt about this, right? And so as the S&P pulls back, we just saw on those channel charts, the energy sector seems to be pushing higher. And again, it doesn't make up a large portion of the S&P itself, but the point is that this area, this sector is certainly compelling, or making an argument that you should allocate or at least overweight to this part of the market right now. And we can't talk about energy without looking at the oil chart. So here's WTIC, like crude. Again, the chart we've been drawing now for many months. Here's the announcement that the White House is going to start refilling the SPR, the Strategic Petroleum Reserve levels, right around this buy zone of 67 to 72. It's certainly held. And now what's happening is we're starting to see a trend change to the upside. And what's very interesting to me is that it just made a recent high. So if we're making higher highs, and it looks like a series of higher lows so far. The trend change was going to come eventually, and here it is about to play out right before your eyes. Now, this is not your typical 50. This isn't a 50 exponential moving average, 55, I should say, exponential moving average. But you could probably draw the 50, and it's going to be close enough for horseshoes and hand grenades right here. Okay, this is an interesting chart. Now, I typically don't do this, but I thought it made some sense to look at the dollar. So if I just squeeze or, really zoom way out and look at, many years here on the chart from 2021, where we saw the dollar trading in around 90, then the Fed started to talk about inflation and raising rates, and the dollar will go in the same direction as rates and opposite of bond prices. And that's exactly what happened here. So recently, we've just seen a downward trend in, all right, and I built a channel here, but we've also seen a retracement. So what's interesting to me anyway, is that the top end of this channel would break the downtrend channel that it's put in for many months. Now, it could just be something that happens, for a day or a spike higher, but I would think we do have to pay attention to this. Now, it doesn't play into the narrative of lower rates, not at all. And so this is why you want to look at multiple parts of the market and just kind of keep this on your radar, but don't overly focus on it. But just notice the channels where they are on the downside and on the upside. So if they correlate here, that's interesting enough. It could just spike here and be temporary. You have to watch rates and you have to watch bond prices to kind of validate that. But we just talked about the Fed funds rate and what can happen with unemployment if unemployment starts to move higher. If you start to see unemployment move higher, you should see potentially the Fed lower rates, and the dollar should either subside any kind of uptrend it's had, or maybe just trade sideways for a little bit like it did here in this region here, and like it did for many times, in the past. It can stay sideways for months, if not quarters at a time. All right, jumping over to the Chaikin system, we just want to look at what's happening here on the XOP, which is your oil and gas exploration and production ETF. It's something that we've been calling out, but just recently I'm seeing a trend change. Money flow has been really strong to the upside here, so it's sort of beating up that negative relative strength that we saw for many parts of this year, and just recently starting to see a trend change, right? So we just turned bullish on this ETF. So this is a sort of a freshly bull rated ETF, something you want to focus on. Again, just seeing all of these parts of the energy sector come together at once. So let's look at the OIH real quick and pull up the components here. Very similar looking chart. We've been more bullish on this for longer, I should say, but the trend changed earlier, just about the middle of July, about a month or so ago. So this one was ahead of XOP. It's just about the components and how it was sort of weighted inside of there. So nothing other than the fact that it's just a different set of standards and a different set of weightings inside the ETF. But the point is that this is also tracking to the upside. We get a strong trend, incredible money flow here, certainly oversold right now, but the relative strength is to the upside. So I think that's kind of interesting. And the last group I want to focus on is the refiners. Let's get a little bit more focused. Again, this is not a widely popular ETF, except there's not that many assets in it. It pays almost a 3% dividend, but it's kind of interesting. Only 6 bulls here, but there's not only that, we're only rating 7 names inside this ETF right now. So when I say only, it's 6 bulls to no bears and only 1 neutral. So all of these refiners are looking good. Now, a lot of these are in the other 2 ETFs looked at as well, but this is more focused on just refiners. So Valero being, one of the largest refiners here in the US, just changing trend and literally changing trend as of Friday to an upside above the 0.5 here that how we reference our trend changes. And again, just turned bullish last week as well. So an interesting name, an interesting group of names to kind of focus on. All right, and to follow up from last week, we talked about retailers turning or changing trend. Tomorrow we've got retail sales coming out. So I think that's interesting, about 8:30 or so. I'd pay attention to that and go back and look at some of those names that we talked about in the previous week. Again, thanks for tuning in. Follow me on Twitter and show me some love here on YouTube as well. Throw some likes down below. I really appreciate it. Take care. We'll see you next week. All right, it's a blooper tape. Gosh, it's bad.